You're syncing up and tuning in to the Lending Link podcast, powered by GDS Link, where the modern day lender can dive deeper into the future of data, decisioning, and credit risk solutions. Welcome to the show, everyone. I'm your host, Rich Alterman, and today we're syncing up with Peter Renton. Peter is the CEO of Renton Co, LLC, a consulting firm specializing in fintech media, events, and thought leadership. Peter was formerly the co-founder and chairman of FinTech Nexus, a fintech media and events company that produced 31 large-scale events worldwide. The events business was sold to FinTech Meetup in 2023, and the media business was shut down in 2024. Peter's been writing about fintech since 2010 with over 2,500 articles. He is the author and creator of FinTech One-on-One podcast, the first and longest-running fintech interview series. He's conducted more than 750 interviews and panel discussions and has produced over 1,800 newsletters. Peter's been interviewed by Wall Street Journal, Bloomberg, the New York Times, CNBC, CNN, Fortune, NPR, Fox Business News, the Financial Times, and dozens of other publications. Other credentials include co-founding NSR Invest and president of Renton Media from 2009 to 2014. In this episode, Peter and I will be discussing the evolution of FinTech Nexus, the impact it has had on the industry, some key industry insights, and so much more. But before we dive into the interview, please head over to our LinkedIn and Twitter pages at GDS Link, that's GDSLINK, and hit those like and follow buttons. If you've not done so already, please subscribe to our podcast on Apple Podcasts, Spotify, or wherever you prefer to listen to your podcast. All right, now let's get synced with GDS Link. Welcome, Peter. Hope you're having a great week so far.
Hey, Rich. Good to see you.
Great to see you. Where are you joining us from today?
I'm in our podcast studio in our office in Denver, Colorado.
Well, thanks so much for joining this afternoon, and a little intimidated sitting here with the podcast guru of the fintech industry, but really happy to be with you today and learn more about your background and impact on the financial and fintech services industry. But before we get to talking about business, I'm sure you've listened to some of my podcasts as I have yours. And I always like to start out with something a little personal to get to know people a little better. And in sharing some initial exchanges with you, I understand one of your favorite summertime activities is hiking in the Colorado mountains, and that you and your wife take a backpacking trip every year covering 40 to 60 miles of remote terrain over 4 days. It's pretty incredible. So why don't you please share a story of one of your more memorable trips, and maybe talk about any hiking destinations that you still have on your bucket list?
I have so many hiking destinations on my bucket list, but let's start with the backpacking trip. We only just started this fairly recently.
Okay.
It was during the pandemic. We used to always do day hikes, did a lot of that, but then during the pandemic, when things were kind of crazy and being outdoors was pretty safe, so we decided to start backpacking, and we've done like 4 or 5 trips now. Actually, I think 4 trips, and then got our 5th trip coming up here in a few weeks. But I think I love the Colorado Trail, which is a trail that goes from Denver to Durango, which is one of the ones that's on my bucket list. It's just under 500 miles. And one day I'd like to do that from start to finish in one summer. But so we've been doing sort of some segments of it. And last year though was my favorite one we've done, because we did there's this thing called the Collegiate Loop. It's a big loop in right up very, very high up in the Colorado mountains. We're talking average elevation of around 11,000 feet.
Oh wow!
So it's high. And what we did a portion of that, and then we made our own kind of. We were following existing trails, but we made our own loop because I didn't want to do the full 150 miles. We did about 52 miles, I think it was, over 4 days. But that was just spectacular. We started off on the Colorado Trail, and then we cut off into this very unused trail, and we didn't see another human for about over 24 hours on these trails. And we camped out in the middle of nowhere, right at around 11,000 feet. And it was just so incredibly peaceful. And the next day we hiked what's called a 14er here in Colorado, which is a 14,000 foot mountain, because it was only about half a mile out of our way on this trail. So we just dropped our bags and went up the last half mile and summited Mount Belford for those interested, and and it was hiking a 14er in Colorado is something that I do every year. I've started doing it with my son when he was 8. He's now 17. So this is actually going to be our 10th 14 we're going to do later in the summer. But this was just with my wife and I, and it was such it was a 14 that, again, we're in a pretty remote area. If you do one of the 14ers near Denver, you're going to be sharing the mountain with 300 to 500 people on any given day. Whereas on this day, in where we were, there was 3 people that we encountered the entire time, and there was no one on top of the mountain when we were there. That was just on the way back down. So
Sounds nice. Sounds great.
that was a very memorable trip for us.
I'm going to give a shout out to one of my best buddies from high school, David. He recently climbed up to base camp for Mount Everest.
Wow, that's impressive.
Yeah, I did a lot of training for that, and yeah, so a little shout out for him. Do you have that on your bucket list?
You know, I am just not interested in that particular thing. What I've got on mine is like there's so many great hikes in Europe. Like there's the Circle of Mont Blanc. There's a whole bunch of other ones there. There's the Alta Via one in Italy, in the Dolomites. That's another one. You got the Camino in Spain, which is obviously a very long hike, but something I want to do. And then I want to also do hiking across England, like from coast to coast. That's a fairly becoming more popular, that hike. I love Norway. I have Norwegian ancestry and tend to do a bit there as well. And then, of course, South America, Patagonia is on our bucket list. And I have an Evernote document that I keep adding to. I started it probably 3 years ago.
Right.
And I've got about 40 hikes on there right now of things we want to do.
That's terrific. Well, thanks for sharing that. So let's get down to business. You've been involved with the fintech industry now for over 14 years and have played a major role in helping to advance the various players' understanding of the fintech space and the impact that it's had on the financial services industry. So back to our hiking, I'd like to take a hike with you back in time to learn what triggered their initial interests in the space and the terrain you've covered along the way to arriving at your new company, Renton and Renton Company, LLC. So let's put on our hiking boots and get started. Let's really take this journey back in time.
Okay, well, if I start at the beginning, it really starts when I arrived in this country in October of 1991. Yes, I am quite old, and I came over here for 3 to 5 years. Was my plan to set up the family business, build it up, either sell it or put someone in to manage it. But I loved it here. Decided to keep extending. I ended up getting citizenship. Married an American, had kids and all that sort of thing. So, but that was sort of the reason I came here was for business. And it was something that I never expected I'd be setting up my life here. But anyway, the family business.
Yeah, let me interrupt. So what was the family business?
If you remember the days of catalogs, direct mail, this was a direct mail catalog, but it was focused on labels or stickers for business. Okay. So we had the largest selection of business labels in the world. And we sold it all through direct mail. This was things like your account is past due, thank you for your business, anniversary labels, anything that you would send. Typically you would send through the mail, right, in a business to business way. But I saw the writing on the wall with the internet and email and the popularity of email, and I sold that company in 2005. And before I sold it, I actually started another company because I knew I was selling it, that was doing digital label printing, and because I could see that was going to be a new trend. And I was actually the first label printer on Google AdWords back in like 2003, because I started this company in 2001. And so that was a life-changing company for me. We ended up selling that to one of the largest publicly traded printing companies. They paid way too much for it. They probably paid double what they should have, but it was good for me. And then I was done with printing. It was really my father's industry more than mine. I've always loved finance, always loved investing. So I remember reading an article in Money Magazine in like 2008, because I sold my second company in 2008, and then interest rates went to zero. And I saw this thing about how I was looking for how to get yield. I wanted to get yield on some of this big pot of money. I didn't want to put it all in the stock market and in the bond market. So anyway, I've discovered peer-to-peer lending. And so I opened up an account at Lending Club. I was like June of 2009, and just started investing, and then was really happy with the returns, open up one on Prosper. My wife's entire retirement savings into Lending Club. And this is back in 2010, and just was very, very bullish on the whole concept and the yields. And I saw that no one was really writing about this space. It was pretty nascent. And so I love to write. I sort of toyed with starting a blog on something, and I thought this is something I can stick my teeth into. So I started blogging. I started blogging about peer-to-peer lending in 2010, and I was a full-time blogger. I was taking some time off because we had 2 young kids at home, and I wanted something that I could do remotely or just not have an office, and so was doing this, making money from sending, it was on affiliate marketing, sending investors to Lending Club and Prosper. That was my primary source of income.
For what it's worth, actually, it was your blog that had me invest in the Lending Club. So
good to see.
I had some good returns too.
Yeah, I still have. I mean, obviously, Lending Club doesn't have individual investors anymore, but I still have my my Prosper account that I opened in 2010, and although I have most of it in a retirement account that I opened there in I think it was 2014 as well. Wow. So I'm still love the returns that I've been able to get there over many years. But what happened was I had a blog, I had a community of people that would actually come and read my stuff, and then people kept on emailing me saying, you should start a conference where we could all get together. And I said, oh God, I don't know, I don't really want to start a conference. I don't know anything about doing that. And it kept on coming up. Then I actually was cold email, or was a LinkedIn actual email from my now co-founders that said, well, do you want to start a conference? And I was like, funny you should say that, because yes, I do. And so we started the first Lended event June of 2013. Right. It was sold out. We had to turn people away, and it was we didn't know what we were doing. We sold 50 tickets more than we should have. And it was very, very crowded, but it was a success. That continued on. In 2014, the first one was 350 people. The second one was 1,000. Third one was 2,500, and it just kept on growing. And we grew back then. This was lending was sort of the hot sort of area of fintech. There was payments that was hot, and Money 2020 covered payments, and Lend It covered the lending space. And we kind of, we grew up with all the likes of, of SoFi and Upstart and Lending Club and Prosper, and all of the fintech lenders were, at our event. Most of them were sponsors. We got all the CEOs to speak at various times, and that became a big deal. Then we also, at this, concurrent to that, because at the time when we started Lend It, we didn't think this could possibly be a full-time job, a full-time business. Organizing a conference, you do it 4 months a year, and then the rest 8 months a year you do something else. So we started Lend Academy Investments, which was Lend Academy was the name of the blog that I started, and we started a peer-to-peer fund, and then Lend Academy Investments sort of became NSR Invest, because we merged with, this is really getting into the weeds here of the history of peer-to-peer lending. We merged with a Nickel Steamroller, which was how I was doing my investing was through Nickel Steamroller. So we did that. We ended up building that up and then selling that in when was it? We actually merged with Lending Robot, which was a competitor to the Nickel Steamroller, and then we sold the whole thing in 2019.
So within that model, so consumers would actually leverage your fund and let you do the actual investing of their portfolio, or was it more advice on how to strategically invest in Lending Club or Prosper?
Yeah, so we had really 2 offerings. We had the fund, which was managed by us, and then we had the where you could sort of do this self-managed, where you would use the API that Nickel Steamroller had created to automate your investment into Lending Club. Those APIs are still working today. I still invest every single day in Prosper through those APIs. And we had all the history of so you could do a lot of data analysis. I went through, back in those days, you could get serious lift from doing analysis of the history, and you could get 400 basis points above the average if you knew what you were doing, and so that's what I would create. I'd create my own, back test it, and then use the API to invest in the Lending Club and Prosper notes. we built up the conference business, and then what we started to see, companies like SoFi and MoneyLion, they were really foundation. Both of those companies were very foundational for us. We were with them from when they started, basically, and they were going. And we really started at SoFi. They were going to other areas of fintech outside of lending, and so with MoneyLion, and we thought, well, we don't want to be left behind here. If all these peer-to-peer lenders, or online, they were called marketplace lenders back then, if they all start going into other areas of fintech, they're going, we don't want them to not come to our events. So we started branching out ourselves, and we really went into a lot of digital banking type content. That was and payments as well. We started to go out and and credit cards, which sort of blends payments and lending, and so we kind of we diversified. We still were very strong in lending. We still considered ourselves the largest lending event, because more than half of our content, more than half of our attendees were focused on the lending space. But we had, for those people that were interested in other areas, we had plenty of other fintech areas to choose from. Right. So we did that, and then we had the pandemic, which just about killed us. We were a week away from declaring bankruptcy when the pandemic PPP, the PPP money, the second PPP came through, and we scraped by, but we still had a lot of debt coming out of that. We had a good 2022, which helped us pay off most of our debt, but not all of it. And then 2023 for us was not a great show. We suffered from the fintech downturn, if you remember it. Yep. Obviously started in 2022, and then we had an event that was financially really not that successful for us. So we started shopping around our event, and FinTech Meetup agreed to acquire us. And that was, they acquired the events business. Really what they acquired was our customer list and a signed non-compete. Right. That was one of the simplest acquisition deals you'll ever do. It was like the whole legal document was like 8 pages. Right. And so that, and then I started working with FinTech Meetup to help produce their event. A few of the lender team went over there to work full time, and so we helped put on their event in 2024. And we'll still be working with them in some capacity now that I'm a free agent. Then fast forward to this year, maybe I should back up. During the pandemic, we started a digital media business because that was the only way we could make money. Because you were just to give you an idea, because the pandemic started, we all know, in March of 2020 when it really kind of hit home in this country. And our event was for the middle of May. And if you run an events business, what you do is you start selling, or you sell all year long. And as you sell tickets, you sell sponsorships. And as you sell, that funds your business as you go. Mm-hmm. And then you get a big last chunk in the last like 3 months of the event, you sell about half your revenue, sometimes even more than half. And so we had sold a whole bunch, and then we got the pandemic, and suddenly we had people asking for refunds. And so we had, I can't remember the exact numbers, but it was something like $2 million in the bank and $2.5 million of refund requests. Wow. So we were basically bankrupt right then. So what we did was we thought, well, let's just really, we were finding our webinars, because this was new. The pandemic was such a new territory for all of us, particularly in the lending space with consumer lenders. We would have webinars. We'd have 1,000 people on a webinar. Typically it was a lot less than that, but that, because there was so much interest, the small business space, the consumer space, a lot of interest. So we started selling webinars. And what we do is, instead of refunding a company, we'd say, hey, okay, we owe you $30,000. How about we give you 2 webinars, and you'll get your leads, because we're not doing an event, so you're not going to get leads from our event. You'll get leads from the webinar. So we ended up churning over, I would say it was well over half, probably 2/3 of that refund request got soaked up by the digital offering. So we had a thriving digital media business. And so we kept that going all the way. And I thought the pandemic would end. No one would want to do a webinar ever again, because we'd been on Zoom nonstop for 4 years. But that wasn't true. People do we were doing webinars once or twice a week, all the way through from, basically March of 2020 all the way through till June of this year, before we closed the business down. But the trouble was we couldn't do enough of them to really make it work financially. And we prepared the team way down to like 5 people. But that's what we thought. After we sold the events business to FinTech Meetup, we thought, let's see if we can really build, like, we'll put all of our effort into digital media. And we thought that could really be a thriving business. And it turns out it's really hard to make money in that business. So while we certainly did webinars, we certainly sold a lot of advertising and email blasts and that sort of thing, we just couldn't make it work where it was a really sustainable business. We didn't break even over the past 12 months. So we thought we would give it 12 months and it didn't work. So we shut the company down. Well, as I'm recording this, it was 6 days ago. So it's still very.
Well, thanks for joining us on the heels of that announcement. Well, great. Yeah, thanks for that. And it's when I was preparing for the podcast, I felt like I was doing a genealogy exercise and trying to track all the different moving parts of your career there. So thanks for helping us walk through that journey. So when we talk about FinTech Nexus, formerly known as Lend It, you've had conferences in the U.S., U.K., Europe, Latin America, and China. And I thought it might be interesting to ask you, as you're looking to do this in China, what were some of the unique challenges you had pulling it off there? And, where, from your point of view, where is China today from a FinTech perspective compared to, let's say, the US?
Yeah. China is the most fascinating country on the face of the earth for FinTech. I think that was the most just craziest 5 years. We started in 2014. We had our last one in 2018. We got up, we got up to like 2,500 people at our Chinese event, because the thing about China back then, they all wanted to learn from the US, even though, and particularly if you look at the marketplace lending space in China, it was larger than the rest of the world combined, significantly larger. And it was monstrously big. And so we came along and everyone wanted to be at our event because they wanted, like, it was sort of a badge of honor to be like a speaker, a sponsor at our event. So we actually ended up doing really well there for a short time, but it was incredibly challenging. You needed the right partner. None of us spoke Chinese. None of us had any experience. But, from the very first event, I still remember the meeting in 2013 where we had these 10 people from China signed up and bought a ticket to our 2013 event. We thought, what the hell? Okay. And then they wanted to meet us. So we talked to them afterwards and they said, we want you to come to China. And we thought, well, we just started this business. Let's table that for a while. And they kept on. And so we did an exploratory trip in 2014. And then we co-branded a conference in 2014 and 2015. In 2016, we launched our own unique conference that we did ourselves. And we started off with a partner that just didn't get it done. It was going to be a disaster. Then we found a different partner. And this new partner was someone who actually specialized in bringing FinTech executives, or it was back then, it was really more of the lending space. They would bring, we had for our 2015 event, I think it was, in New York, they brought 250 people from China to our New York event. So that was when we saw them, they'd never put on an event before. So but we ended up going with them as they weren't our original partner. We went with someone who'd put on events before, but they just were doing nothing. Like, we had zero sponsorship 4 months out. And so we got this new company. We ended up doing really well. But you think things are last minute here in China, things are crazily last minute, where we get 1,000 people signing up the week before the event. It's just so insane. And then obviously you've got to do everything. Everything has to happen on WeChat, and you have to take payments that way. And it's just all very, very different. Like, email doesn't really exist in China in any significant way for business. It was all WeChat based. And so our partners helped us all with that. We brought people over. We actually ended up doing, we had executive tours, we call it. We did them, I think we did 4 executive tours 4 years in a row, where we'd bring Western executives to China to learn. We go introduce to the leaders in the Chinese market, introduced to investors. I mean, some of the investments that happened for many of the the lenders in the US and the UK came through these executive tours where we would introduce them to the Chinese investors. And then what happened in 2019, we were putting together our the next year's event, and we found that we had zero sponsorship signups. And we knew that things were last minute, but normally we'd have like 20 or 30 by 4 months out. We had zero. And that was just because the Chinese government was clamping down on the peer-to-peer lending space, right, and no one wanted to be seen in public at an event. So they we just had to cancel. There was just it was so obvious that we ended up having to paid our cancellation fee at our hotel and just canceled the event because we were like, our partner said, you could do this event and you could have 50 people. You could go from 2,500 to 50 people. That's how dramatic it was. And then the final footnote to all that is, there was a lot of fraudsters in the peer-to-peer lending space. So all you needed to start a peer-to-peer lending company, you needed to create an app and you had to pay like a $20 licensing fee to your local telecom company. That's how it worked in China. And you had a business, and there was all these fake borrowers, and it was a lot of fraud happening. The biggest Ponzi scheme outside of Bernie Madoff was a peer-to-peer lending platform in China called Izubao. Wow. But there were lots of other smaller ones. And I was talking with our Chinese partner just a year or so ago, and he was saying that many of our 2017 sponsors and attendees and speakers were in jail because when we didn't know, Izubao, we didn't allow them to sponsor or speak because there was rumors happening during that time and that they were bad. But a lot of these other ones, they'd fooled everybody. Anyway, it's a fascinating place.
Is peer-to-peer still going on in China, or is it totally shut down?
It's not totally shut down, but it is 95% smaller than what it was at one point. And and there's all the serious players, there's just some smaller players left. The serious players moved on. It's kind of like what they did in the US for a lot of it. They just moved to institutional backed funding. It was less hassle, and the government was okay with that.
Well, good. That's a great segue to my next question. And as you mentioned or alluded to, and we certainly both know this, that Lending Club made a decision back in October 2020 to basically shut down their retail platform at the end of 2020. And yet, as you mentioned, you continue to work with Prosper. What are your thoughts on why Prosper did not go down the same path as the Lending Club as it relates to the shutting off the retail investors?
Well, it's funny. I was just chatting with Scott Sanborn recently, the CEO of Lending Club, and we were talking a little bit about that time period. And I don't know if Lending Club didn't want to buy a bank, which in hindsight has been a really smart move for them. They've done much better than the non-bank online lenders in the last year or two since interest rates went up. I think Lending Club probably would still have had it wasn't a heavy lift. And the thing about the pandemic, I remember when talking with Lending Club and Prosper in the early days of the pandemic, the retail investors stayed. I kept my auto invest. I was just auto investing and just kept everything going. And they had whereas institutional and bank investors completely shut down, not completely, but a lot shut down. Whereas retail just kept on chugging along. So they were a good, reliable source, just a small source of capital. And Lending Club being much bigger than Prosper, it was a much smaller percentage. And so it wasn't a huge deal. I mean, I was personally very disappointed. I still remember that phone call that I had. They were telling me that they were going to do this. And I didn't know at the time they were starting a bank because they didn't share that little tidbit.
Right.
But then we find out a few months later, literally less than 6 months later, that they're acquiring a bank. So that was sort of, I think, the biggest impetus. And and I was talking with Prosper a few months back, and they're still committed. So they say anyway, they're still committed to their retail investor platform. I think for that reason, because it is very sticky, and it's not a heavy lift now. They've got automated investing. You don't have to use it, but the API like I used to use with Nickel Steamroller, but you can and it's a great product. It does. I mean, these days it does the sort of delta between what you can get risk free and what you can get in peer-to-peer lending isn't as wide as it once was. But when interest rates were zero and I was still chugging along at 7% at my Prosper and Lending Club investments, that was pretty significant. And it's the 7% has gone up a little, but it hasn't gone up as much as the risk-free rate has gone up.
Right. Okay. Well, we're going to take a little detour for a few minutes and kind of step away from the fintech world. We'll come back to that. So, as we mentioned, you've been doing your podcast, FinTech 101, since before you started FinTech Nexus, and my understanding is that you've done over 500 podcasts with no end in sight, and that's quite a number. I know, having done, I think I'm up to about 37 since October 22. So I don't think I'll ever get to your number, but as a fellow podcast host, I know we're not supposed to have any favorite guests, but perhaps you can share, a few of your memorable podcasts that you conducted and what made them stand out.
Right. Well, we're just to clarify, we're not officially at 500 yet. I know if you go onto Apple Podcasts, you'll see that there's more than 500 in there. But what some of those things were not podcasts. We used to do a news show that we would publish onto the news feed. We did a few of those. So the official number right now, I think I'm going to publish it today. It's like 490. So we're very close.
You'll let us know when you hit your 500.
My goal is 1,000. So I'm going to keep this going for, it's taken me, 11 years to get to 500. So I think in another decade, I'll get another 500. And that's, then I might retire, who knows? But I want to get to 1,000. That's my goal. But so many great episodes over the years. It is really hard to pick a favorite. I will go with first name I'll go with is Mike Cagney. I had him on 3 times, twice at SoFi, once at Figure.
I know, Mike.
Each time he just blows me away. He is. I think if he's not the smartest guy in fintech, he's in the top 5. And a great executor, a great salesman, has done incredibly well, with, SoFi, obviously, massive company that he led for its first, 6-7 years of existence. And then, with Figure, just breaking new ground in technology, what they've done at Figure, I think is just astounding. And he is always, if you never get a chance to chat with Mike Cagney, you will come away learning something new. I've chatted with Mike over the years dozens of times, always find I learn something brand new that I've never heard before when I talk with him. So it's fascinating. Other ones I'll shout out to Max Levchin. I did him about a year ago. CEO of the firm. He was on my bucket list of guests that I've been trying to get on for years. Finally got it done. And he didn't disappoint. He might be in the top 5 smartest guys in fintech as well. Super smart. And just the way he thinks so deeply about the payment space and the lending space and their intersection, which is where kind of a firm plays, and just, again, their ability to create partnerships. I mean, he did Walmart. He's been a partner of Walmart for 6+ years now. Right. And the company was still relatively small when he got that deal done. And now you got Amazon and just the amazing, Apple. You've got the biggest companies on the planet, and a firm is in there as a fintech partner. Really, really impressive what they're building. A couple others, David Marcus, who people may not even recognize that name. You should. He was the guy that, remember when Facebook were going to launch a digital currency or a digital payments tool, digital wallet? It was, what was it called? It was Libra. Libra was what it was initially called, and it went through various names before they ended up shutting it down. It just wasn't going to work politically. But David Marcus was the guy leading that. But Mark Zuckerberg chose him specifically, and he was a former PayPal exec. I had him on because he's doing something different. He's got Lightspark is his company now, and he's doing payments infrastructure on Bitcoin. But forget about crypto or Bitcoin. It's nothing to do with the token. It's about the technology that underpins it. And So it's basically an instant payments network that is a rails that are coming up in in completely separate from the Visa, MasterCard, the Fed rails. It's a really interesting company, super smart guy. Loved interviewing him. Last shout out, one I just did fairly recently, Luke Voiles, one of my favorite people in fintech. He's the CEO of Pipe. Known him since his days at Square and Intuit. He is just so enthusiastic, so infectious enthusiasm. It was just so fun chatting with him and just seeing what I think, he's in the vertical SaaS, revenue-based finance type space, really building, I think, a unique company there.
So you allude a little bit to innovation. So why don't we talk about that for a second? What do you consider, let's say, the top 3 innovations in fintech since you've been involved?
Boy, there's so many, I think, great innovations, and I'm going to go with my favorite one, which is earned wage access. That's number one, because earned wage access I see as a substitute for the payday lending industry, and I've never liked payday lending. I feel like it gets people into a debt spiral. Earned wage access, it's something that should have happened. I mean, if we had started payroll from scratch today, earned wage access would just have been part of the payroll system, because it's ridiculous that you loan your employer money all the way through when you start work after payday, all the way through the next payday. You are building up a loan. You're giving your employer this free money, and then finally they make you whole at the next payday. It shouldn't be like that. And we've got, if you're an Uber driver now or a Lyft driver, you can get paid after every single drive. I think that's great. If you want to do that, that's how it should be, and you should be able to choose whenever you want to get paid. And that's what earned wage access provides. So you're 3 days before payday, rent is due, or you're out of money and you can't afford groceries, and you would go down to a payday lender, or a check casher or somewhere, or just some really a thing that's not going to be good for you financially, and you could potentially turn a $250 loan into $1,000 repayment. Whereas you can just get your $250 advance on money that you have already earned. It is yours. Right. You just haven't received it yet from your employer. Earned wage access provides a way to do that. You can do it instantly, usually for a fee. If you can do it, usually like for a day or so, it's free. And so that's a great innovation. My favorite. So in the last 10 years. Another one I'll say is BNPL. When I started in this space, there wasn't such a thing. Although Klarna was around originally, but then you had Afterpay, and Affirm started up more than a decade ago now, but really made this into a phenomenon. I used to notice it because I'm from Australia. I'd go back to Sydney. Afterpay were in Sydney, and they really were. I'd go down to my local mall while I was in Sydney, and I'd see all these Afterpay signs. So I had to find out what it was, and then every time I went back, there was more Afterpay signs, and then suddenly I went down through the mall, and every single company that wasn't just a restaurant or something, every single company that was selling products that cost like $50, $100, $200, every single one had Afterpay. And so I saw it firsthand, and then it became bigger in this country. And I think consumers love it because consumers don't love credit card debt, but half have it because for many reasons, mainly because they often can't quite budget the money that they have, or they just don't earn enough money. Whereas with BNPL, you don't pay all that interest. You can you can sort of plan your spending in an easier way, and I think that's why consumers love it. And there's going to be regulation come down, and it's going to mature. But I think it's been amazing because it's gone from nothing to a preferred form of payment for a huge chunk of the population.
Just to pause you there. So so as far as regulation, right, it was I think May this year where CFPB issued an interpretive rule concluding that buy now pay later are really a credit card under Reg Z. So obviously there's going to be some adjusting there for the industry to.
Yeah. I mean, some have disputed that.
Yeah.
Some of the BNPL players are on board. There is, I think, significant differences. I think it wasn't as nuanced as I would have liked to have seen, but it should be an entirely new framework. It is not. There's a lot of things. You talk to Max Levchin about credit cards, and he basically thinks that credit cards and payday loans have more in common than credit cards and BNPL, and that. I think there's an argument to be made for that. But
I was just going to say for our listeners, we actually did a big podcast on BNPL with Liz Hagel over at TransUnion a couple months back, and that's when we were talking about all the reporting.
Yeah,
the credit
reporting is key. Reporting
Yeah.
is key for this to really.
challenge.
Yeah.
So number three.
Number three. So I would say I'm going to go with cash flow underwriting. Very much a lending centric innovation that, when we started in the lending space, we were doing, conferences for a while before this really got going. But it was like 2017, I think, was the first time we did a session at one of our events on cash flow underwriting, and no one was in the room because people thought it wasn't that interesting. But now it's become, I would say, fairly mainstream, and particularly with open banking and the 1033 rules that are coming, and because basically cash flow underwriting means you need access to the bank.
Right.
You've got to get the bank data, and that really is so much more useful than a credit report, which is all backward looking and doesn't actually include income. And so your bank account includes what you're actually spending your money on right now and how much you're earning right now. And it's just it's a way that it's still used as a second look for most lenders these days, but I think the credit reporting industry is very well entrenched in all fintech lenders, obviously banks as well. But I see cash flow underwriting having more and more of a role, and I feel like it's going to become much bigger. And then soon, I was talking with a lender the other day on my podcast. I can't remember exactly who it was, but it was arguing for the fact that what I want to see is someone using cash flow underwriting not for second looks, but for first looks.
Right.
And that is still not really happening, but I think it's inevitable. It's going to, because I just think you can do a soft pull on a credit score. You can do cash flow underwriting together. You're going to get a much broader segment of customers that you'll be able to apply to. But more importantly, you get much more accurate pricing.
Right.
And you know exactly what's going on. And I think it's been a great innovation. I thought when I first organized a session on it in 2017, I thought by now we would be further along than we actually are. But it's taken a while, but it's really getting some momentum these days.
Yeah, I think the 1033 rule is going to help clarify a lot. There's a lot of discussion in there about the requirement potentially to be a CRA and support adverse action. And certainly from a financial inclusion perspective, right? There's still 50, 60 million, whatever number you want to pick out. You've heard so many different numbers that are thin, no credit file, and that ability to pull that bank account to really help round out and get a 360-degree review.
And and the aggregators today, though, the cash flow underwriting, not enough all of them are, but many of them are CRAs already.
Oh, absolutely.
They've already gone through that process.
Yeah, more and more are becoming CRAs if they're not already. Plaid rolled up a separate division, right? It Plaid CRA Inc., I think it is.
Yep.
So yeah, I think once those rules come out, it'd be good to help clarify things. It's been an interesting week in this industry with Synapse and Evolve.
Oh, God.
So just to update our listeners if they're not aware, obviously we had the bankruptcy, and Synapse has had a major impact on many consumers on platforms supported by their product and preventing many consumers from getting access to their funds. There's been large discrepancies in asset balances that have raised concerns around vendor risk management oversight processes of their bank partners. And, it's hard not to feel that this is a little bit of a black eye for
more than a little.
A little more than a little. So you actually published a piece on this. So maybe, let you, not to steal the thunder, kind of talk about what you focused on and, what do you see, long run? Is this just going to bring that much more, regulation into this space?
What a debacle. I think it has been, and that's why I said in my article, I think it's the worst thing in the history of fintech, the worst development that we've ever seen. It's a disaster for the tens of thousands of consumers that, you see horror. I've read many horror stories of someone with, $38,000 down payment for a house, can't get access to his money, loses the house that he wanted to buy. And just people think that they're banking with a fintech that is doing business with an FDIC insured bank. That should be, your money is safe. And this is where I think Synapse, you got Elena McWilliams running the show now as the bankruptcy trustee, and she's extremely experienced. But the reality is, these people, as we're recording this, they can't get access to their money, right? And that is just an abomination in my eyes. And so the regulators are going to come down hard. I think it's something that until it gets resolved, and that Elena Williams saying it's like, she even put out I read something that Jason Mickler wrote, and I think she was like wondering whether it's actually resolvable. Like, maybe the data is not available, which is just staggering to me. And so you got these people with these accounts, and there's many fintechs involved that were sort of using Synapse as an intermediary between their bank and their customers. You see, I'm worked up. I'm mad because I'm mad for the consumers, but the damage done to fintech is substantial. And I think there's going to be, there's going to be ramifications that are going to last a long time because of this. Because regulators typically regulators act in a crisis. They don't often act when they don't have a crisis, when they should act, and they typically overreact after a crisis. So we're probably going to get an overreaction, and it's going to be harder for fintechs to operate. That's bad.
On the heels of it, I was reading in Forbes website, there's an article where the FDIC had issued a new warning to consumers about using neobanks and fintech companies for banking, specifically referring to third-party banking apps, non-bank companies offering banking services. And the article actually had a quote from the FDIC saying, "You may want to be particularly careful about where you place your funds, especially money you rely on to meet your regular day-to-day living expenses." Now, I don't know how many consumers that use neobanks for fintech apps are reading articles related to guidance or statement from the FDIC, but clearly, a statement like this could favor big financial institutions, and perhaps could it inflict pain on the fintechs, impeding the valuable competition and innovation that they've brought to the market.
Sure, it certainly could. And I think, let's face it, maybe 0.1% of consumers, I think that's a high estimate, read FDIC guidance. Right. And they're just not involved in the banking industry, right? If you remove those people, then there's very, very few people that read it. So I think that in and of itself is not a big deal, unless you start to get on the front page of the New York Times and on CNN, which has already happened with the horror stories that was happening. It happened in May when this first started breaking. Right. They've moved on to other stories now, but these people are still suffering. And the FDIC, this should have happened. A long time ago. There's the reality is that the regulators were asleep. The banks were asleep. Synapse was asleep. They did not have all their ducks in a row. And if this should never have happened. It's not. To me, you're talking about money movement, a lot of money movement. It's not rocket science to get this right. And it's not rocket science to actually make sure that it is right. Why when and a lot of these banks are state regulated, so they don't have the OCC breathing down their neck. They obviously have the FDIC, but the state regulators don't have the capacity or the knowledge, particularly if you're in a state like Arkansas or even some of the smaller states that just don't have the manpower that a California or New York banking regulator would have, and all the knowledge. And so they get through their regulatory exams, and no big deal. Like with Evolve, with Lineage, with a lot the other banks that have been involved in this debacle, Where were the banks? How did they get through their exams?
Right.
And that's the thing that I think, clearly Synapse was at fault and did many things badly. I don't think there was malicious intent there, but they certainly didn't do things well. And the people running these, running the programs at these banks didn't do things well. And because I'm still staggered about it. So it's, the FDIC was shutting the door after the horses bolted.
Yeah. And look, Evolve just had the cyber attack.
I know. And could it get any worse? Like,
could it get any worse?
It can get worse because it was just yesterday, I think it was. It feels like 2 weeks ago, but it was just yesterday that we learned that there's been a data breach that in fact it impacted many fintech companies. Evolve, I think Evolve has maybe more than just about anyone else. I mean, the Bank Corp's really prolific, but Evolve has a ton of clients that are really, their now data has potentially been breached. I just saw on Twitter, on X this morning, Max Levchin tweeting out that they know that the Affirm card was partnered with Evolve, and so there's some exposure there, and they're trying to figure out what's going on. So a lot of bad things that are happening right now in the banking as a service space.
Well, look, you also have the attack on the auto industry, right? They've been 2 weeks, and well, I know we're coming up on our time here. So we're gonna probably have to cut some of our questions short. So what I'd like to do is give you that opportunity. We started our discussion today with the journey from before you were even involved with the fintech industry, and recently rolling out your new company, Renton Company. So I'm going to give you an opportunity to do a little plug for your new company, and how could some of our listeners benefit from the different services that you offer?
Sure. Well, thank you for that, Rich. I appreciate it. Yeah, I mean, this is obviously a new company. When we dissolved, FinTech Nexus, or we actually declared bankruptcy to be precise in that in the terminology there. I started. I know a lot of people in the fintech space. I've had a lot of people reach out to me saying, "Can you help me with X or Y?" And so I thought I needed to form something that is that can help provide my expertise and help sort of house my services, so to speak. So it's Renton Co. That's Renton and the word and .co. That's the website. There's a contact button there. You can get in contact with me. And it's just Peter at Renton Co. as well is the email. But I'm sort of what I love doing. I love doing media. I love doing podcasts. I love doing events. I love writing, doing newsletters, all that sort of thing. So I am now available for anybody in the fintech space or the banking space who wants to up their media game, shall we say? And I'm happy to. I've already starting to work with a small number of companies, and happy to take on more.
Well, look, this has really been great. Thank you for joining. This is Rich Alterman. We've been syncing up with Peter Renton, CEO of Renton Company and co-founder of FinTech Nexus, formerly Lendit. I want to thank Peter for joining me today and taking us on your journey in the fintech industry. On behalf of the financial industry, I want to personally thank you for the positive impact I know you've had on the understanding and the growth of the industry, and the personal and professional relationships your events have helped to foster. I know I've met a lot of great people through those conferences, and call a lot of those people now friends. Congratulations on your new venture, and we look forward to staying connected to the industry via your podcasts and writings. We hope you all enjoyed this podcast. Please stay connected with GDS Link and the Lending Link to listen to future podcasts and catch up on the ones you've missed. If you're interested in listening to Peter's podcast, FinTech One-on-One, you can find them on his website, fintech1on1.com, with the numbers spelled out, or on Spotify or wherever you listen to your favorite podcast. Thank you again, Peter, and that's a wrap.
Thanks, Rich. Really appreciate it.
Thanks for listening. If you've enjoyed today's episode, please be sure to subscribe on Apple, Spotify, Google, or wherever you listen to your podcasts. And be sure to leave us a review. Follow us on LinkedIn and connect with us on Twitter at GDS Link. That's at GDSLINK. Have a question for the show or have a specific topic you want us to cover? Hit the link in the description to drop us a note. Thank you for lending us part of your day. Make it a great one.